it's still doing its little oscillating thing. Okay, maybe now it's doing better. Not really. It just cannot focus. Okay, there we go. Man. Hello, Camille. Hello, everybody. All right, we're gonna go over to the market. Maybe possibly some of the trades we did today, possibly, and then we're gonna go over option selection, how to select options. Thank you. Hopefully, hopefully it'll be good. All right. So today we had a gap open from SPY, and then it was red for a while. That looked like it meant it was going to be a top. And if you look at SPY, you can see that it kind of looks like it's in a channel, right? Well, that gives you some indication that it could potentially be at the top of a range right now. And you can always look at RSI. I don't know if I have that down here. Yeah, I do have RSI. RSI is currently at 65. So yeah, it's at a roughly overbought point. So today I did get some SPY puts, but man, SPY ripped it after hours, and that's why you want to wait until confirmation. And once you see one of these candles turn red on the day, and then start to seep into the high of the previous day, that could be an indication that we've topped out and we're now going to go on a run to the other side. A little bit of a minor correction might happen. So right now, SPY's been on a run, amazing run, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 sessions. But really, 1, 2, 3 of them were sideways. Another 3, 1, 2, 3. So 6 of those sessions were sideways, and 3 were up. So it's been 6 sideways sessions and 3 up. So that's why it just seems like the market's just drilling you right now, because when the market goes sideways, you can't get direction on anything. And if you're a midday trader, oh, you're going to get really clobbered, because most of the corrective moves, most of the adjustments based on news and hype, whatever is happening out there, happen right away in the morning. If not pre-market, but right away in the morning for about an hour, maybe an hour and a half. And then things level off on the day. You can see that across just about any stock. We can take a look at a couple. And so on a day like today, yesterday, and the day before, or any of these choppy days when the market is just starting to range, if you try and get into a position midday, like, what are you doing? Like, it's not going to go anywhere. There's no direction on the day, and then you're picking the lowest volume point in the day to try to select some direction on something, and it's just not going to work out, and you're going to get whipped out either at your stop loss or probably at a loss, and it's just going to happen over and over and over all day. If you do that midday trading on a ranging day, very, very difficult. Definitely for the advanced traders to be trading counter trend strategies such as ranging and against the trend. Anyway, so already in after hours, SPY has pushed up even further. Let me see if I get the number here. 409.27. So all the way up to about right here. We'll have to see what happens in the morning. When things get this overbought, conditions start to exist that are overbought, either economically or trade-wise. Like there becomes this push and pull in the economics out there, and there's too many bonds, whatever it is. The weighting, it goes through these cycles and these imbalance, seesaws. And it's going to happen in the next few days at some point, if not tomorrow. Something's going to give, and then you're going to start to see the market do some correcting. The market, as you can see, you can literally see, does not go up every day for eternity. It just doesn't. It has to always cycle, has to always be cycling, has to get overbought. So people have to basically feel it's overbought, and they're stop buying. You know, they go, like, just a minute here, like, hang on, smart money, just everybody, even like, medium intelligent money, however you want to label it, just starts to get on the sidelines with cash and go, you know, I have to go with cash because this is getting too overbought. Because, if you're going to buy low and sell high and you're a successful trader, whether that's a swing trader or day trader, doesn't matter, anything. You're going to make sure that you're not getting into overbought situations, because that puts you at a very high risk. So on days like this, you're bottom hunting. You're hunting for something like that. Maybe it's tomorrow, Camille says, Friday. People will be selling off for the weekend. It could trigger something like the whole week's gains. People are going to take all those profits and just like bank it, right? And maybe you should too. Be careful. Although, Elliot, weren't you telling me once before that there's never been a red Friday? And that's not true. But I think Elliot had a little maybe insight in that there's very, high probability that on Fridays, the market never closes down, or very rarely closes down. He's had some statistic about that. No, it's markets don't bottom on Fridays. Okay, so what do you mean by that? In other words, if the market's been pulling back all week, then Friday is not the bottom? Is that what you mean? Well, you have to explain that to me later. But that's a very curious statistic, and I'll have to look that up. Give me some supportive evidence. I'd like to look into that. All right. So anyway, and then the VIX today, my God, that was just wonderful. Got into the 16s. It hit 16.5. Like, whoa, guys. Like, if you're not like averaging in to some insurance in your portfolio, either on SPY puts or on VIX calls, wow, like what a great time. I mean, you can just pick up some some VIX calls down here around, 16s. And if there's anything cataclysmic that happens in the world, like in the next 6 months, because you can get like a 6-month option, this is the time to get it down there. My God, I can't even believe we hit 16 today. So like if we just take a quick look at the VIX options here, since we have them on the other screen, you guys over on TikTok, you want to click through the link in my bio to come into the YouTube so you can see this full screen, or into the Discord or in the Zoom so you can see this full screen. But for example, you can get all the way to September right now. Usually you can get about 6 months of VIX. That's how they sell them. And they're usually about $800 for the at the money. So I'm looking here right now, it's $830 for the 16, And what that means is that and that's usually the best deal. You can't get much of a better deal when it comes to VIX. You just kind of got to buy the at the money. But for $820, you can have the 16s, and in 3 months you can revisit them, maybe do something with them, sell them, exchange, whatever you want to do with them. In the meantime, it's giving you protection. So whenever there was a crash, for example, that crashed back in March of last year, VIX was down at hanging out around 12. So that's like really, really stable time in the market, 12. And VIX popped up to 80, 85. So that's, but throughout the rest of the year, and this could easily happen again, you're going to get spikes. You're going to get VIX spikes. Throughout the rest of the year, we had spikes go to 44, go to 37, 40. We recently had a spike to 37. So what does that mean? It means if you're holding the 16 and the thing goes to 32, let's say, right? Let's use even numbers. So let's say we're at 16 and it spikes to 36. That's 20 points of gain. And by that point, you'll probably have about, because of the deltas on your options, about $1,800 of gain. So you got to figure, okay, it'll cost me $830 to just have this insurance in my portfolio. And by the way, that might not dwindle to nothing, when it expires. Let's say the VIX is 24. Well, the difference between 16 and 24 is 8. You'll actually be worth $800. So you'll get your money back if that's the case. But it is true that possibly the money you're spending on the VIX option may dwindle into nothing. But during these times, recovering, economic crisis, these can be times you have to watch out. Or when you hear people saying like, hey, is the market going to crash or what? Like, if you're worried about the market crashing, this is what you can do. So you get $830 of protection there, and it will give you, on just a medium spike to like 36, $2,000 of protection. So you have to say, okay, well, how big of a fall is a jump to 36? Well, you can kind of see that relatively here. We were at 24 and went to 42. So that's almost a 20-point gain, like I just told you. And that was in October. Let's take a look at SPY. And what you do here is you figure out how much of a drop is that going to be in my portfolio. So you go over to SPY and go, okay, that was right here. The market was at 353 and it dropped down to 322. 353 to 322. So 322 divided by 353. Don't mind the air conditioning unit in the background. That's intentional. That is a 9% drop in your portfolio. So you have to say to yourself, okay, $2,000 of protection will protect me against a 9% drop in my portfolio. So you just go, divided by 2,000, or 2,000 divided by that. What am I doing wrong here? It has to be the inverse. So it has to be 1 minus, and then that over 100, blah, blah, blah. So anyways, 9% of protection on $2,000 will be divided by 0.09, 22,000. So in other words, one VIX option will protect your portfolio if it's worth $22,000. So one VIX option protects $22,000. That's basically what you have to remember right now. So if you have a $100,000 portfolio, you need 5 VIX calls. Does that make sense? All right. And if you don't have a $20,000 portfolio, then you probably don't need to get any VIX protection, because you're going to get about $20,000. You're going to be protecting about $20,000 worth of money by buying one VIX call. So anyway, now are times in which they are very, you're getting a really good value, because if the VIX goes to 17, 18, 19, 20, you're even going to be experiencing some gains. So you'll be getting that extra buffered protection. It's a hedge. It's a hedge. It's a crash hedge is what it really is. There it goes. It just happens like once an hour. All right. So today I want to talk about how to select options. It's going to be very cool. Pretty in depth, as a matter of fact. So we'll go really quickly over what we traded today. So let me take a quick look. We had Oracle for the upside and Nike for the downside. Those were the big winners. Let me double check if there's anything else that was a big winner. What's underneath here? No. All right, cool. So we had Oracle for the upside. And let me change out to the 1-minute graph on that. It's pretty hard to see on this kind of a system. But Oracle did very well today and went up and up and up and up. And we had that for upside play. And then we had Nike for downside. And again, it's probably hard to see, but that is down, 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 down all day. So that was, let's see, Nike paid off 67% gains on Nike. And the other one was, what did I just say? Oracle. Yeah. Open up. There we go. That's not showing my gains on that, but that also was really good gains today as well. All right, now let's take a look at options and selection. And like, if you're watching on the YouTube, I mean, the TikTok, you probably should come into the Zoom. Click the link in the bio there. So definitely going to be doing this example with deer because it just makes sense. There's a lot of context here. This will make sense to you once you start to learn about this. Hopefully some of you want to take notes even possibly, but you'll probably be able to watch this later as well. So let's say you're looking to get into some kind of a swing. Okay, first of all, let's talk about day trade. Let's just get that out of the way before we get into the swings. If you're day trading options, you basically want to select something that's slightly at the money / in the money, even out of the money, mostly dependent on the liquidity of the option and nearest expiration. And you have to be 100% committed to the fact that you're not going to hold it overnight because when you select at the money or even slightly out of the money or even slightly in the money, you are going to be subject to theta decay. And because you're getting the nearest expiration, that theta decay is going to be most rapid, especially if it expires, say, tomorrow or even at the end of the day today. You're going to see rapid theta decay. So you don't want that. And we'll go into like what that is in a minute here. Not technically, but just in a way that you'll be able to understand. So here, if you're not watching on the full screen, you're missing out. I'm going to drag this over here. Maybe this will help. But I don't think you guys are really able to see that on TikTok. But if you were going to want a day trade, for example, deer today, let's say you wanted calls, then you would be looking at what's at the money. So at the time that you'd be looking at the calls, deer was like 374. The closest nearest at the money in the money option was 372.50. Okay, so looking at that, you can see the delta is about 0.56, and delta is how much money you'll make per point of gain on the underlying. But what you really want to look at is the bid-ask spread and the volume. So you can see here the volume says 64, but if you jump down one option, you can see the volume's 85, and not only that, the open interest is 1,100. And what is open interest? It means that's how many contracts are open and being held by people right now. The volume says how many have traded today, but so far there's been 1,147 of those contracts that are being held at this point in time. That's open interest. That has accrued. Those people who got into that are holding. That's accrued over the last months. So anyway, you will find that the options with higher volume and higher open interest will typically have a better spread. And let's just examine that and see if that's true in this case. So the difference between 705 on the bid and 770 on the ask is approximately 8.5% spread. All right. Now the next one down from there was 565 bid versus 615 ask. 565 divided by 615. And that one is almost roughly the same, actually, 8.1% approximately. So actually that one is a little bit better. Now you're going to see situations, I don't know which one to pull up right now, but you're going to see situations where you're going to see that much more extreme. Let me think of something that's kind of like, I don't know, maybe AMD. Let's see. Wow, a lot of volume on AMD. Oh, that's the April 16. And how about here? Wow, so much volume compared to what we were just looking at, deer. So much more interest on AMD, Kelly. That's amazing. Than deer. So anyway, why did that just move? That's really weird. Okay. So anyway, for day trading, you want to pick the one that has the tightest spread and it's getting a lot of volume. Look at this one has 211 volume, which is the 372 strike, but this one has 76 volume. So you want to pick the 211 volume. And the reason is because when it comes time for you to sell it back, there's going to be somebody interested in that minute or few minutes. So, there's 6.5 hours of trading, 6.5 times 60 minutes. There's 390 minutes in the day, and it had 211 volume, right? So 211 divided by that. Again, this thing. There we go. That's a one. I believe is one volume every 2 minutes. I don't know why I have that calculated that way, but so on that one, every 2 minutes, someone's trading an option on Deer, which is not very active, but at least it's a hell of a lot better than if you chose this one, the 370, which has 76. Now, usually the rounded numbers like 370 have more volume and more open interest. 375 have more open interest and volume than like 372.5. The 0.5s, the zeros and the fives, or the even numbers like that, have much better volume liquidity than the 0.5s. Okay, so that's for day trading. You know, it's really not that difficult because you can pick any option when you're day trading. And if the stock goes up, all the calls go up. They all go up some amount. It's just relative to what you bought. They all go up. So you can't make like a mistake if you're just day trading options. They all make money if the stock goes up and that was what your intention was. They'll all go up. However, you will see a more accelerated rate of return on the out of the money option. So if you were to choose like one out of the money, it will be cheaper. And then when the price of the stock goes through that and it becomes at the money or even in the money, it's like your money, your return is going to go through a parabolic curve, and you will see an accelerated return. So that is one potential strategy when you're day trading, is you could potentially get a one out of the money strike. But look at the quality of once you go out of the money, the quality of the options go way down, because look at the bid ask on that. The bid is 128 by 184. Jesus, that's a 30% spread. Maybe some of you don't even know why that matters. It matters because, why don't we get this in focus here? Okay, I don't know, it won't focus for you guys, but okay. It matters because the minute you buy, you have to buy at the ask. And then when you want to sell, you have to sell at the bid if you want it to fill, right? So if you buy at $1.84, that's $184 for 100 shares. So you buy that, it's $184. Instantly, no one's interested in buying it from you except for at $128. So that means you're down. You're down instantly. Like you just bought the option and you're instantly down 30%. You're down the spread. So when you have a huge spread like that, that's a real pain in the ass. You don't want to trade options with huge spreads. And I've even seen options where it was like $2 for the bid and $8 for the ask. Like, what sucker is going to be buying that? Make sure when you are trading options, try to put in your offer at the mid, the price that's between the bid and the ask. It makes it like in stock share trading for day trading, it's not that big a deal, but in options, it's a big deal because it saves you a ton of money. In that case, if you were to be able to get the mid, instead of a 30% difference, if you got the mid, then you'd only have a 15% instant loss once you bought it. But by the way, yeah, that's a bad idea, Don't buy options that have really wide spreads. Yeah, we're going to be going over Deer. We're going to be going over options, Kelly, and we already went over SPY. Like, were you late? Oh, yeah. You missed it. Okay. You're just being funny. All right. So listen, let's move over to swing trading now. And this is where options become like really shine. Options are like best for swing trading. I'm hoping you guys are going to be able to see this over on the Zoom, over on the TikTok, because the focus is just going in and out. Maybe if I move my face down a little bit. Oh, yeah, there we go. Can you day trade without capital? Yes. You'd have to do something called joining a prop trading firm, but you'd have to be a proven trader. And what you do is you trade with their capital. Oh, I see what you mean. Maybe you just practice. Yeah, you can do paper trading. So you can paper trade is what it's called with Webull or Thinkorswim are two popular platforms. Good question. All right, so look on this deer stock, it's been reset price scale. It's been channeling like for a long time. See how it's just running, channeling for a long time. And channeling is like when it ping pongs back and forth between a low and a high end of a range. And that allows you to, I mean, trading channeling stocks, that's, one particular way to make money. If we draw a parallel channel on this, we can get an idea of what we can expect to get out of it and when to get in. The nice thing about TradingView, that's the software that I'm using right now, is after you've drawn that, you can like adjust your points a little bit, get the angles right, make sure that you get the most coincident lines drawn on there. See, there we go. Okay, so now on deer, what we might expect in the future, let's see if I can get the blue or green, pink, here we go, is if you, every time you would have bought at the bottom end of this channel, make this a little big for the TikTok people, you have a chance at it running to the top end of the channel because the thing is trending. It's highly trending. It's been trending for about a year. And so therefore, you can buy in at these levels, 280 in this case, 300, and then end up selling at 360. Can you imagine buying at 280 and selling at 360? Well, I can tell you that if you were to buy the options on something like that, that's a 80-point gain in the period of February to March, about 1 month. So we can look at 1 month options right now and say, okay, how much would it cost me to get, that much time right now? And it's about $1,100. And it will be worth, however, let me get you that information. It'd be worth about $8,000 when you sell. So that's a huge gain. So this is why this can be a very lucrative way to make money. This is called swing trading. So now looking at this channel further, we had a further opportunity recently. Let me get the eraser here. Hang on. Eraser. There we go. We had opportunity to get in more recently, and we did in our group get in around this region here. Is it drawing? There we go. And you actually had a entrance today. Kelly, did you get that 369, it looks like? What did you get in at? Kelly, I think you picked up some more today, didn't you? Yeah, my ear, sure. You should probably do that. So now we expect over the next, month or so. Wow, that's amazing, Kelly. 368-ish. That's insane. So as you can see, this particular stock, you can get a statistic. You can get some statistics on it, and you can see that in about 1 month it makes its run, and sometimes it even does it in less time, like this one, which was about 2 weeks. So between 2 weeks and 1 month, we can expect this thing to go up to about 445, something like that, from where we are now, about the 360 to 370 level. So how many points is that in gain? 30 and 45, 75, again, another 80 points a gain. So we can predict about 80 points a gain on this over the next 2 to 4 weeks. So here is where option selection comes in. This is going to be a little bit more complicated, so I'm going to draw it as best as I can. But you guys got the idea that this is what we want to do because of what I just showed you. We want to get in for that move. So the first thing you want to know with your option selection when you're doing swing trading, and you can just trust me from this, from all my experience, is you want to buy 3 times the duration of your expected move. It's going to cause the option to cost more, and you're going to be pissed off about it. But believe me, it's worth the money to do this for 2 reasons. And I'll probably try and illustrate it here with lines, but For now, just let me tell you that if you were to buy an option that's 3 times the duration, so we need like a month, right? We want a month on this. If we buy a 3-month option, well, when you buy an option, you have to pay like a rental fee on it. And so for that time, you have to imagine it like a rental fee. And if you have bought an option you expect to hold for a month, but it has 3 months of rental fee on it, then when you're ready to trade it back in a month or in 2 weeks, how much rental fee will be left on it? A lot, right? A majority. Like with 2 months left, it'll be 66% of the time that you bought into will still be left. And with just 2 weeks, if it made the move in 2 weeks, there'll be almost 80% of the rental fee value still left. So when you trade it back, you'll get more money. But here's where it really helps you is what if the trade goes bad? That's really where it helps you. So if the price were to drop and you want to sell it back, you want to get rid of it, well, guess what? It's going to be worth a lot more, even though it went down. It may have went down in value, but it still has plenty of time value. Like no one can get away from the fact that even though it might have dropped below the strike that you even bought it at, which would normally make it worthless, they can't take away the fact that there's still a ton of rental fee value on it. And so you'll be able to have the protection of rental fee value to sell it back. So it becomes insurance in 2 ways. One, what if it takes more than a month? Like we just saw it took, 2 weeks to a month. So in one respect, you'd think, okay, the insurance that he's talking about, why I should get a long option. Okay, I get it. I'm going to get it because maybe it'll take longer and maybe I want more time. Not really. That's only one aspect of it. And yeah, that will be nice, because what if it takes 2 months? You could still be in it. That will be nice. But the other aspect is if it goes down, you'll have so much more rental fee still on the contract that when you sell it back, you'll still have a lot of retention of your original capital. That's what it's about. So that's why you want to get 3 times duration. So rule number 1, get 3 times the duration of your expected move. When swing trading options, always get 3 times the duration of your expected move. Now, rule number 2 is always get about 75 delta. And now this is where I'm going to try and explain why. Blue, green, and red, I suppose. Let's see, green, blue will be at the money. Well, okay, before I move on from there, any questions about specifically that last little bit there about duration, picking 3 times the duration? Let's see. You said if it went down from here, where would you get out? Okay, well that's another system. Right now I want to talk more about option selection. You're talking about strategy. Would you buy a put 3 times the duration? If your play was a put, then yes, you would. Pretty straightforward, says Camille. Renato says, I bought Apple back in January and followed your 3 months advice, and it started to lose value and run sideways, and my expiration was next week. It is now 30% up, and I plan to sell it tomorrow. Yeah, man, see? It's just so nice. Oh, here's another thing. This is like an final exception rule, maybe like rule number 10 with options. If it's the final day of expiration, or maybe the final week of expiration, final couple days of expiration, and you've been holding this thing, it got away, whatever happened, there was a crash, you weren't looking one day and it got away from you. It went down to 80% loss at some point. And then now it's like the final week, and now it's like 90% loss. And now it's getting to the final couple days, it's at 95% loss. You're losing everything. You paid, maybe $2,000 for it. It's now worth $150. And you're like, well, whatever, right? I mean, $150, By the time you try to go to sell it, it's worth $120, and you're like, well, And then the thing starts moving up, and it goes 130, and you're like, well, shit, and you keep holding it. So let's say for whatever reason, you're in a situation where the last few days, and you're maybe even on the last final day of your option is next to worthless. We call it like $50. $20. It even can go to $5, $100 on those last few days. Don't sell it to get your money back. And I'll tell you why. Because I've seen it happen time and time and time and time again. About 1 out of 10 times, about 10% of the time, 1 out of 10 times, sure, it's a long shot. 90% of the time, it will expire worthless. But I will tell you, it's amazing. One, probably because they orchestrate it with other people holding the options, and it's an inside type of situation. But I will tell you that about 1 out of every 10 times, something happens with the stock on that day extraordinary. Something, Microsoft announces an agreement with whatever, and boom, it goes up 60 points. Facebook, this, blah, 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 blah. Man, those kinds of cataclysmic deals seem to always happen on Friday during option expiration, and you have this worthless option, and it just wouldn't have been worth it for you to take back your $30 when it could have skyrocketed to $3,000 or $4,000 or $5,000. See, the difference there is much better. That it happens like 1 out of 10 times, but the difference there is much better than 10 to 1. It can be like 20, 30, 50 to 1. So that's a kind of a very distant rule, but like a final little tip is that if you ever have an option that's just damn near worthless and it's going to expire today or tomorrow, just let it run. Just let it run out. Just let it run because something may happen. Don't try to get your $7 back or whatever it is. You're going to be all right. Okay, so listen, now we want to talk about at the money, in the money, and out of the money options. So let's do it on this. So let's take a look at which option we would select on this. We know we want to get something about, in this case, 3 months out. So we know we want 30 days times 3. So we want about 90 days. So the closest one here, we have 71 and 162. 71 days out and 162 days out. So I'm going to turn the 71 because that's going to be fine. Yeah, Nikki, exactly. Kelly says, that happened to me. It jumped and I made big money run on last week on a 6-month contract early in my option trading. Yeah, it does happen. It's bizarre. I think it's a manipulation. It's just, you're going to just find it's about 1 in 10. All right, so if we bought the at the money, currently the price of Deere is $374. Okay, so this, if you're new to options, this may be very helpful. I'm going to get some of these little arrows off so that you can really understand this. Okay. I'm going to go with a little bit of a thinner font. Here we go. So at $374, that's the current price. I'm going to mark that with something for you guys, orange, a little orange line. Don't know if you'll be able to see it, but here it is. The current price of Deere is right here, $374. It's that little orange line. Okay, now a little bit thicker. There we go. So 374. Now we're looking at the contracts. For those of you on TikTok, you need to click through the link in my bio or the YouTube link and come over to the YouTube so you can see this full screen, because I have the options chain next to this and you're not seeing that. So click through the link, and come on over to either the Discord or over to, so you can get into the Zoom, or over to the YouTube. So you can see the options chain right next to the graph. All right. So if we were going to, the price of Deere is $374. If we were going to get something that was basically at the money option, here's some of our choices. We have the 370, which is trading for about $2,000, $20 per share. Or we have the 380. So those are our choices, the 370 or the 380. The 380 is $1,500. I would call the 380 pretty much a bit out of the money, but we're going to explore getting like the 400 in a minute, because I know a lot of you are going to be thinking that. Look, our goal on this is what, again? We're talking about $445 of gain as our goal. I'm going to put that in pink right up here. So we're looking to get out right up here. Okay. And I might need to move this. What is this? June 21. Oh, shoot, I'm going to have to move some of these lines. I'll just draw some of that stuff again. But I want to get the expiration in view. So June 21, April, May, June, July. Okay, and let's extend this out all the way to the expiration, June 18. That's exactly the expiration right there. And this seems to be the best angle. Boom. Yep. And by the way, when you're drawing these channels, yep, it is arbitrary. Yep. So people say like, hey man, you can't, that's not exactly it. It's probably a little bit higher than that. And it's arbitrary. You can't make money in that. That's bullshit because it's arbitrary. Dude, I can take a gun out of my pocket and point it in the general direction and kill a guy, and that's arbitrarily pointed. Okay, it still works. And in fact, that's what I call this. I call this cowboy style. Options are cowboy style. There's no person on earth who can predict options perfectly because the numbers change. They change. They're constantly in flux. So you just generally arbitrarily point in the right direction, and that's how you make money with options. So pay attention, because if you're skeptical, you don't have to be, because skepticism is sort of built into it. You point the right way, you pick the right thing, the thing goes up, you just make money. It's not going to be $7,327 like you exactly thought it was going to be, but it's going to be maybe $6,980. Are you going to be okay with that? Or are you going to go, this is bullshit? All right, so listen, here's our price target, 445, right? So we're expecting to hit 445 at some point in the next 2 weeks, and we're going to buy a contract all the way until June 18th. Let me draw the expiration line for you. I'm going to draw that in thick black. There you go. June 18, right here. This is the end of the line. This is the option we've decided to buy, June 18. Okay, now, what we said was the 370 option. That's right here is the one we may be interested in getting at the money, the 370 option. How much is it? $20 a share. What does that mean? It means that by expiration, if Deere is not $20 above 370, so 390, then you're not going to be. So let's draw that out. June 18, 390 is right here, and you're buying it for right here. Okay. 3 at the current price all the way to expiration. You need to beat that blue line in order to make money with the at the money option. Okay. Now let's say we got the 400. The 400 is $8 per share. So $800. So you might need to follow me on this for a second, and then we'll come back to this. So 400 strike is what that's called. Cost $8 per share. So it's going to cost you $800. It's $8 per share. And it means that by expiration, if the price isn't any higher than $408, you won't get your money back. You will get your money back, but you won't have made any money. That's your break even. This is your break even line. All right. So that's the difference in the slope there. That's the difference between an out of the money and an at the money type of option. Okay. And that was for the 400 strike right here. I need to get rid of this. Okay. And put a blue right there. The other one we chose was 370. Now, what happens if we get the something more in the money? And so I recommend, when it comes to in the money, that you get something about 75 delta. In this case, that would be the 340. The 340. So you're like, wow, why would I get the 340 option? Well, you're going to see in a second here. The 340 option costs $4,000. You say to yourself, holy shit, it was going to be $2,000. to get the at the money option, why on earth would I pay $4,000 for an option that's in the money? So it's at 340, 340 strike. Well, let's figure that out. From 340 plus the $40, so $4,000, is 380. That becomes your break-even line. Oh, I should have drew the other one in red. Let me just switch that out just real quick. Oop. Okay, out of the money is terrible and should be red. Okay, but now if you buy the 340 strike, your break-even will be 340 plus $4,000 or $40 per share. 340 plus 340 is 380. So you have to beat the price of 380 by expiration. So as you can see, depending on the option you buy, you cause yourself to be under more or less stress. So if you like, let's just go over it again. If you bought the what did we say, 400, the 400 strike for $800, you need to beat this red line in order to break even. If you bought the 390 strike, I'm sorry, the 370 strike for $2,000, you need to beat this blue line. And if you bought the 340 strike for $4,000, you need to beat this green line. But more importantly, let's put that into context. Let's grab a price here. Let's say the price at expiration of deer, let's say it went like this. Okay, it didn't go the way we hoped, and it did this. Okay, now what kind of situation do we have here? Well, you can visually see now that your out of the money option lost money. And for the last few weeks, you basically lost all your money. The at the money option, which is the blue line by expiration, it stayed pretty much above water, but you broke even. But the in the money option, the whole time it was above water. The whole time the price was above that green break-even line, you were profitable the entire time. And by expiration, you actually made $1,000 because it was at 390 at the close, and your break-even was 380, and so that's about $1,000 of gain. There's definitely still a lot more to learn because there's intrinsic value and extrinsic value. But really what I wanted to illustrate there is the beauty of choosing in the money options versus out of the money options, because you really set yourself up for disaster with out of the money options. Let's, for example, say, let me get rid of, that black line. Let's say that for the out of the money option, you didn't get the 400 strike. Maybe you didn't have $800, but you wanted to play. So, but you looked further down the chain, and you decided to get just for $300 the 430 strike. For $300, the 430 strike. Okay, let's take a look at. So that means by expiration, you need to beat 433, because you're talking about the 430 strike, and $3 is what you paid. So by expiration, if you want that thing to be worth how much you paid or more, by expiration, you're going to have to beat 433. So you buy the 430 strike. So what does it look like? 430 strike, you have to beat this red line, or you are losing money by expiration. If at any point during the journey of that stock, the price goes below that red line, you're underwater. So if it goes like this, people who bought the blue option there are doing fine. People who bought the green option are doing even better than them. But you aren't looking too good. Now you're losing money. And in fact, you pretty much have nothing left now. And these guys, look at this guy, boom, boom. It came right up to about 430 by expiration. You lost everything, $300. Not that bad. But some people do the stupid thing and they buy 10 contracts at $300, which was $3,000. Instead, now they lost everything. They lost it all. They lost all $3,000 in that case. But instead, they could have just bought $3,000. They could have bought like the 350 strike down here. It would have cost $3,000, and they would have had a line to beat of about right there, and they would have made a ton of money. For the same exact money, they could have bought one option, and instead of losing everything, they would have made a fortune. They would have doubled their money, probably made $6,000 or more. So that is the power, the problem with buying out of the money options, and the beauty of buying in the money options. I want to start just by asking any questions at this point. So this one person asked, so the only reason you want to buy the out of the money is because it's cheaper, right? Well, I mean, right, like psychologically, the only reason you want to buy that option is because it's cheaper. But strategically, you don't fucking want to buy that option, even because it's cheaper. Because of what I just said, it's going to set you up for disaster. You wouldn't like buy, let's say, 100 out of the money contracts on something when you could buy with the same amount of money, whatever, maybe even one or two contracts that were in the money. The in the money contracts will make you so you don't sweat the whole process. You'll make money. Whereas the out of the money contracts will be losing money every day. You're probably going to lose everything on out of the money contracts. So what is the point of out of the money? To give gamblers something to blow their money on, I guess. It's the dumbest shit out there. I don't do out of the money options. Anyone smart who's done options for a while doesn't do out of the money options. There are times when you could do an out of the money option. You could get but they're for lottery scenarios. So like a crash protection, you could get SPY puts way out of the money. Puts would be down low. So you kind of got to get a little bit more advanced thinking here, but you would buy a price of SPY, for instance, SPY, the market, like way, way, way down low, like 250. Instead of 400 where it is now, you get like 250, which is ridiculous. You're saying the market's going to be 250 in a year or something, right? Well, it's going to be cheap because it's out of the money. It's going to be cheap. But basically, you have to know you're kissing that money goodbye, except in the case there was like a North Korean, nuclear missile crisis, and the entire world went in into war or something, and then the market crashes, and then you've got, your payout. But you don't really want to do out of the money options. It's just not a good idea. There very rarely is it a good idea. Let me see what some of your questions are. I went through a lot of that, breezed through a lot of that pretty fast, but hopefully that made a lot of sense. And also another thing that people who are new to options don't understand, two things I really want to make clear. If you're new to options and you don't want to mess something up, that's really important that everybody messes up in the beginning. It's these two things. Number one, the strike price that you get is not supposed to be the price you hope in the future that the price is going to get to. In other words, if we hope that deer is going to get to 440, you don't buy the 440 strike. That's not what that means. You do what I just did, which is you actually buy less than the current price. So the current price of deer is 374. You would buy the 340 strike. It's called in the money. You go deep in the money. The options are going to cost a lot more, but you're going to actually have a chance to make money instead of losing all your money. You will find almost everybody who starts trading options loses all their money, and it's because they don't understand some of these very important concepts. Now, the second most important thing that you're going to make a mistake on, or that you don't quite understand in the beginning, some of you, is that you can trade your option back at any time. So the current value of your option is just like stock. You don't have to wait for expiration. You don't have to be right about that timing, the expiration. You don't have to wait for it to expire. You don't have to wait for expiration. You can sell it back later today if you want. You could sell it back tomorrow. If the price of the option went way, way up, if deer went to our target price like in a week instead of 3 months, then in a week, we can just sell it back to somebody else because they want to hold it for the next 2.5 months. So people who are new to options, those are probably the two most common beginners' mistakes, is they don't realize they can trade their option back at any time. You don't have to hold it all the way to expiration. And they don't realize what was the other thing that well, I forget what that was, but yeah. All right, let me take a look at your questions here. As a hedge, oh boy, there's a lot of good questions here. Excellent, guys. Oh, so what's happening, Kelly, is that some people are like, "Wow, this looks like an actually a good trade." Yeah, this is one of our best trades we have going on right now. Who makes the contracts? Very interesting question. You do. So, but not you. You in the future, smarter you, some other guy just like you, instead of buying that contract, can do something called selling a contract to you because you want to buy one. So you, some other guy, smarter guy with options in the future, it could be you, but on the other side of the table, sells you a contract. And they set the price based on what they think is the most you'd pay for that, which is usually, it's part of the whole market process, the bidding and the sort of what do they call that auction, the sort of auction style process. It finds its price. Um, yeah, so that's a very good question. The target price on deer right now is 445. That's what we're looking for, somewhere between 415 and 445 over the next 3 months. But that's not what we're talking about. We're trying to go over options. I don't know, man. I'll try that. Boo, 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 boo. Let's see. No, that's not the problem. It's doing that even when I have my face way off. All right. Yeah, maybe you're right. Okay. All right. Let me give that a try. You're right. Good job. Uh, other questions here. What are your thoughts on selling covered calls and puts instead of buying options? Well, Kayla, that's what I was just kind of talking about. Is you can be the person not gambling. You can be the person giving other people their gamble, and that would be called selling contracts. But I'm not going to go into that in this tonight. How far out should the expiration date be when buying a contract? So you just missed it, Luke. I definitely went over that 3 times the duration of how long you expect for the stock to take to get to where you expect it to go. That's rule number one, 3x duration. So if you expect it to take 3 weeks to get where it's going to go, you want 9 weeks of time. I explained earlier why, but just trust me. Yeah, you really will thank me later. How close to the current ask do you try to sell it, or do you just go market? It depends on the bid ask. Depends on how tight or loose that is. I need to get some money into my account to buy a contract on deer. Yeah. I have most of my capital tied up in swing trades right now, and I'm going to be probably giving you guys a lot more swing trades now that the market's under 20 VIX. Kelly says, I get it, Evan. Thank you for breaking it down like this. It's very clear now. Wow, that's awesome. Yeah. And by the way, I've never seen anyone ever explain options the way I just did with these lines: in the money, at the money, out of the money. And you can draw a line from the current price you're buying at, and it creates this break-even line that you have to beat on a daily basis. But I'm just a very visual person. And that's how I visualize them. And that is, in fact, what they are. So I wish more people would teach it that way, because it really makes it obvious, doesn't it? So if there's one thing, maybe, in 100 years from now, when I'm long dead, that people might vaguely attribute to me, maybe it'll be something about that, about how to sort of visualize your option break-even line. You just draw it from the current price you're buying it at all the way to the break-even price at expiration, and that becomes the line that you have to beat every day, which also means that if the price goes up, like, look, when it was here, I don't know if you guys can see my cursor. Hopefully you can, but like, for instance, when the price was here above the red line, that person who had that red out of the money option may have said, oh man, this is awesome, I'm going to keep holding. But look what happened is, even when it went back, this is very important, even when it went back to the exact same price a couple days later, the difference between the red line and there is much less, right? So that means that a couple days later, the price of the stock went to the same price, and yet a couple days later, they're not even making as much money anymore. And that's because of theta decay. But this break-even line is sort of reverse theta decay. And this break-even line shows you the rate that you have to beat in order to make money. So in other words, if the stock is not climbing faster than your rate of incline on that, with like for instance on the out of money option, then day by day you're going to only be up the same amount of money because you'll be losing money and making money on the same day. So that means the stock has to outperform that break-even line, and that break-even line is pretty steep. So you really set yourself up for failure when you buy out of the money options. Gabby says, I actually really am starting to understand options because of this. Awesome. Still got a lot to learn, but wow, it's so much more clear now. Can you show how you sell them? Limit or ask for market? Yeah, let me see what happens when I click on that over here. So if I were to click buy, is that going to let me? Yeah. So if I were to click buy, that pulls up the little order window here. And I can choose the price. And immediately in Thinkorswim, it gives me the ask 2070. I don't want the ask. So I want halfway between. So 2035. I want to try the mid. You can type it in or click these little buttons to get down to 2035. But one of the cool things in many of your softwares, but probably definitely in Thinkorswim, is you can just click this button here, mid. You can slide this little slider and it changes the price for you to the mid automatically, so you don't have to do that math. And then you confirm and send, and then you buy the option. That's it. Pretty easy. What was the other question? As someone who understood zero of this, you know how much info this helps. Oh, thanks, Gabby. Even if there's still a lot to learn, it's like wanting to paint but not knowing how a brush works. Yeah, that's definitely a good analogy for sure. Totally. And I don't know why they don't explain it to you so visually like this. It's always got to be freaking numbers like, oh, the theta is this, and the gamma is this, and the vega is this, and the delta is this. I'm going to explain one more thing to you guys about delta. Delta is how much you're going to make per dollar of the underlying increasing. So when you buy, here's another fucked up thing, right? Check this out. When you buy the out of the money option, let's go back to that 400. What is the delta on it? It is 0.3. Okay. That means you're going to make $30 for every dollar that the price of deer goes up. Okay. $30. The at the money, what did we choose? 370 is 55. So the at the money option is going to give you $55 of return for every dollar that deer goes up. But what about the in the money we chose, the 340? The 340 is 0.77 delta. So it's going to give you $77 for every dollar that deer goes up. So now you can see that why you make more money within the money options than at the money and out of the money options. Because the out of the money option, you're only going to be getting $30 for every dollar that the price of the deer goes up. I mean, talk about stupid. I mean, talk about dumb. Like, why on earth would you out of the money option just have nothing to give a person? The only time an out of the money option works is as a lotto play. You are going to lose money. If you're choosing out of the money options, you are going to 7-Eleven and you're buying, 20 quick picks for $100. And if you lose, you can't go back and say, come on, give me back my money a little bit, give me back $40. No, the money you pay for lotto calls and lotto puts, those are what they call out of the money options, is money that's done. You will not see that money again. Don't ever buy out of the money options unless you understand that that is 100% gamble. And you will probably never get that money back. But if you do, that $100 might turn into $3,000. It could be an amazing return, but those are 20 to 1 or more. The odds on those are very, very hard. You can't make a living out of the money options betting. Will we get our money back when options expires on us, even if we don't sell? Yes, you'll be fine. What you're going to do is you're going to get the check this out. You're going to get the shares at the strike price that you paid. In other words, so if you got the 340 in the money options or whatever options, then what happens if you let them expire is they exercise and they become the actual shares. So then on Monday morning, you're going to have that many shares of deer. And then they give you 3 days to liquidate those if you don't have enough like a margin requirement in your account to be holding that much deer. Because like, it could be like you would need $150,000 in your account. But you could just, sell them that day a little bit, throughout the day and even the next day. I believe you have 2 or 3 days to sell them. I recommend you sell them the very next day, Monday. But if you get smart about it, look up the rules, call your broker. You may have a couple days to actually wiggle out. Let's see. Okay. Now, if you're buying puts, you just turn the chart upside down and flip the strikes, right? Yes, Camille. That's exactly it. Like I couldn't have said it any more perfectly. Absolutely. But here's another thing to think about is that you should never buy puts on anything that's trending up, right? Because you're setting yourself up for disaster. I'm just trying to tell you that as just like an obvious point of wisdom. Don't try to short stuff that's going up. Like deer, we would not play puts on that, and that goes for when it goes to the top end of the channel as well. Okay, because if you notice, even when it looks like deer is going back, what you might call down, returning to the bottom edge of the channel, it's actually going sideways. You can't make money very easily, very reliably on stocks that go up on the put side of the trade, because when they go back to the bottom of the channel, they're actually going sideways and they're not going down. So you don't actually make money. So puts are not a good idea. And then but what you might want to do is find something that's going down, like gold or something that's trending down. Get puts on those. But 9 out of 10 bets on the market when the market is bullish are going to be bullish, and it's going to be rare to find those put plays, but they'll be there. When do you sell at expectation or before expiration or before? Is there a difference? No, there's no difference other than if you let it expire, it does what I just said. It turns into the shares, and now you have the stock instead of the option. But maybe that's what you wanted, and that's why you buy the option. Somebody's asking about an upcoming crash. What are my thoughts? All right, we're going to stay on this options conversation here. 3 times duration, correct. And fair to say that out of the money is good for short-term 1 to 2 days play. Let's see. No. If you're going to hold anything overnight or longer, you want to go in the money. But for a day trade, you can go at the money. What's the next question? Out of the money to sell. So buy the most expensive option then. I mean, frankly, yeah. I mean, roughly, yes. Roughly speaking, yes. You're going to start to notice some good deals. You're going to go like, whoa, I can get the 90 delta on this for only $50 more. And I'm paying $4,000 the 75 delta. I can get the 90 delta for just $50 more. Shit, I'll get the 90 delta. Why? Because I just explained to you earlier that if you get the 90 delta, the delta is going to be how much money you make for each dollar that increases in the underlying. So you'll make $90 per dollar increase in the underlying versus $75. So the each dollar that deer goes up, you're going to make an extra $25 or $15, whatever that is. And so I think it is $25. Maybe it's 15. And so just in $3, you're going to already have paid for buying that a little bit deeper in the money, is what they say. For out of the money to sell puts or calls and keep the premium. There you go. Yep. You're starting to get it. Uh-huh. Okay, cool, Kelly. Right on. For us, says don't get pattern day trader banned. Rule number 3. Yeah, that's funny. Uh, okay, now again about quality options strike a selection. You want to make sure that you are choosing the most liquid option, and that will be typically around a rounded number. So here we have things like 300, 310, 320, 330, 340, 50, 60, 70, 80, 90, 400, etc. The rounded ones would be like 300, 350, 400. And you can see that those ones are going to have a huge increase. Look at the increase in the amount of open interest and volume on the 400s. People are buying the 400s. There's 2,288 open contracts on the 400s. 86 of them traded today. So people are ridiculous. You already know there's plenty of people that you can sell those contracts to. And then, but if you go down to like the 300, you'll probably see a bump there. Well, that's a little bit too deep, but yeah. Let's keep looking here. How deep in the money is best? That's the perfect question, Quayne. And my answer is exactly my rule number 2 in option selection, which is 0.75 delta. It seems to be the optimum amount to pay for delta. But again, like I said, if it's only a little bit more to get a higher delta, go for it. What does it mean to get assigned? Um, Assigned to shares. I believe that's in selling options. I am not an expert at selling options and spreads. I'm an expert at cowboy style calls and puts and swing trading them. I just specialize in that. I do really good at that. I dip into options level 3 a little, but I am not a spread trader, which you might find are options level 3 and 4 traders on options and 5. But we have several experts in our group, expert analysts, who asked that question, Tony. So you may be able to ask them. By the way, I almost always sell my contracts before expiration, so I don't even deal with that. On some rare occasion, I might have it expire in the money and then have them be exercised. Now he's down for 90 days. Yeah. If I don't have that much capital, is there a combination of options I can run for the upside? Yes. If you have options level 3, you can do something called buying a vertical, which takes the cost down to about 1/6 the price. If I switch this spread over here to vertical and we try to get that same $4,000 option that was the 340 strike, okay? 340 strike. I switch it to vertical. That's going to cost, instead of $4,000, the 340 is going to be about $700. So that's a huge savings. But don't think you're getting the same thing. You're going to get 1/6 the return and 1/6 the risk as well. So, but it's exactly the same. It just allows you to size down. So you could buy like Amazon options that way. But you do need to have options level 3 to be able to do that. Oh, the delta balance in the portfolio. Yeah, that's pretty awesome. I'll save that for another class though, but briefly, when you buy calls, you are now holding positive deltas in your portfolio. That's called positive deltas. And what that means is that you're exposed to the market upside. That's essentially what it means. It means if the market goes up, you're going to make money because pretty much all stocks go up when the market goes up, and you got calls, so you have positive deltas. You have let's say you got 10 calls on one of those 75 delta contracts. Well, that means you're going to have 750 deltas. Okay, so you're going to be positive 750 deltas. Now, if you're not sure which way the market's going, what you might want to do is find something that's going down, like gold or something else, to hedge against that with an exact same number of negative deltas. So negative 750 deltas. That'll put you at what's called delta neutral. And that way you will make money whether the market goes up or down. And you won't suffer too much stress when the market's fluctuating. Okay, let me continue on with the options questions. Yep, 75 delta is what I recommend. Yes, Nikki, you can get a new contract tomorrow on Deer. Kelly says he's going to be stocking it tomorrow. I want to get Deer, Kelly. I already sold once and I made money. Kelly's like, yeah, same thing. Yeah, so, it pulled back. Look, it looks to be down at the bottom end of that channel, right? So it's an okay point in which to get in. Let me get rid of some of those lines. You see the bottom of that yellow channel? The price right now is at the bottom of that yellow channel. It's at a decent point. I mean, if tomorrow Deer were to go down more, that'd be an excellent buy. That was awesome. Thank you, Camille. When day trading, you want closest expiration and at the money. Yes, right. Thank you, Kelly. I haven't seen anyone go over options like this. It's great for visual learners like me. Totally, Matthew. I'm totally visual. Not that I'm bad at math. I'm actually excellent at math. That was something I was probably best at in school. But I am a very visual person too. Good shit. Is your imaginary theta decay line accurate? Yes, it's the break-even line. And yeah, it's pretty accurate, but it will have some difference because options are not a perfect science. There's too many factors, is why it's a very multi-dimensional product. Because when you buy stock shares, it doesn't bring in the dimension of time. They're forever shares, right? And also it doesn't bring in the dimension of strike price because the value that you're buying is from the price of zero. You're going to hold those stock shares value start at zero. Whereas with options, they start at a particular strike price, and below that price, they're at zero. Like 430 strike, whatever, below that, it's zero, So options are very multi-dimensional, and they're also dependent on the volatility of the underlying, meaning like how consistently and smoothly it moves versus how erratically and crazy it is, right? That's why Tesla options are extremely expensive because it's really erratic, yeah. Me not drawing this on my Deer swing right now. What? Oh, you are drawing it? Was exactly what I needed to see. All right, man. Kelly says, that's why theta decay, when it's at the same price in the money, is less. It's less out of the money, high theta, and greater loss, no out of the money, yes in the money. Yeah, I know it's exactly what you're talking about. Yeah, if you think about it, when you're buying out of the money, you're only buying theta decay. You're not even buying any intrinsic value. That option's worthless. It's nowhere near in the money until the price goes into that strike and starts going above it. Has no intrinsic value. You're only paying for rental fee, which is like throwing money away. But when you buy an in the money contract, you're not even hardly paying any rental fee, especially if you go deep in the money. For example, on that one in the money contract, which is at 340, I have the intrinsic, I think, on here. No, I don't have the extrinsic showing. Oh, here's the extrinsic is, no, that's not that. I don't know what that is. Ext, what is that supposed to be? But look, you're paying $4,000 for the 340, right? So we know the break even's 380 and the current price is 374. So how much is rental fee? $6. Oh, that's what it is. Extrinsic. It says it right there, $6. So you're paying in $4,000 for that particular option. You're paying $600 of rental fee. If you get extrinsic value up in a column on your option chain, you can see how much you're paying for rental fee in it. So at the money, you're paying $1,600 of rental fee. But I'm talking about getting all the way down to $600. The next strike down to 330, you're only paying $500. Next strike down, 375. You can get it to the point where you're not paying any excess money for your option, just about. Yeah. He says they always overcomplicate it in the videos I watch, and it makes it discouraging. Totally. And that's why I really decided to, explain these things and make videos and put them on my internet, on my YouTube, because I couldn't find anybody. Like, my mom, for instance, wanted to get her into options, trying to explain to her. But she didn't like get it right away over the phone or whatever. So then I tried to scour YouTube, for any good options explanations for her. They were all way too advanced and ridiculous and over theoretical, and it's just like, it just doesn't work that way, man. Like, it just doesn't work. I don't know anybody if you're selling options, all that stuff really matters. But if you're just buying options to make money on a move, cowboy style, that's all you need to know. The thing goes up, the option goes up. Bingo. Follow Evan's advice, buy in the money, 75 delta, 3 times duration on the expiration. You'll make a ton of money and you won't lose money, and you're going to thank me, and you're going to do so well. But Evan draws with crayons, and all of us first graders move to second grade. Teacher scores. Mad apples. Literally how I bought my first 5 options, just straight lost. Yeah. Oh, man, that's awesome. With bright, shiny colors. I also thought I bought calls, but I actually sold them. Right. Ooh, I think I remember that. I think I remember when you did that. You have to pay attention to the 2 columns. And that's exactly why you should never start at a higher option level than option level 2. You would not have been able to sell that option if you didn't have options level 4, which you totally should not have. You're going to get yourself in trouble. At most, you want options level 3. Hey, thank you, man. Very nice. More says, best explanation ever for options. Thank you very much. I really appreciate that. Will this session be available on my YouTube channel? Yep. You'll be able to rewatch it tonight. It's automatically going to be posted and in full screen. Yes, sir. Would love to have you follow me. So what is this? Then why is there less or no volume on the 100 through 300 strikes? Because that's starting to get ridiculous. There's not enough people interested in buying or selling those options to you or anyone. It's just not a popular region, Gabby. Who's that? No, I'm sorry. GY26. It's just not those aren't popular. There's a certain, you can think of it like as the statistical distribution. There's a certain popularity distribution of where you can grab your options. And at a certain point, so that's what you got to get good at. You want to become a high quality options selector. You want to get good at that. You want to look at that. You want to look at how those things taper off and start to see where the anomalies start, where it starts to get a little bit yucky, and, stay where it's still a little bit popular. Like somebody said, why not go way down and, pay nothing or whatever and pay the maximum, right? Down, way down, like around the hundreds, no one's even selling. You couldn't get one. But you can start to see that the volume does start to pick up. Interestingly enough, right around the strike I would have bought, 340. It just so happens that's 0.77 delta, and the bid-ask spread is pretty tight. I like it. It just so happens that, that happens to be probably the highest quality option you can select is about around the 0.75 delta, and then 3-month expirations. Yes, I will be uploading it to the YouTube. Any other hot plays like this, but a little cheaper? I wish I could buy a $3,000 to $4,000 contract in the next few days, but I won't have the money ready. Gabby, get yourself options level 3 and buy a vertical instead. And then you'll be able to take these kinds of opportunities on lots of stocks that you normally couldn't afford. But yeah, there's probably other opportunities. We'll look at a couple in just a few minutes here. Lewis can't go to level 3 because he'll fall under PDT because he has to convert to a margin account. Yep, that's what happens. That can happen. So that's okay. I I've been watching videos, and Tony says, I've been watching videos and reading on these options shit for 6 months. And this one session made more sense to me now than ever. Oh, dude, I'm so glad that I got through. Frankly, like I haven't had a cup of coffee, drinking just water here. I'm probably not the sharpest. It's the end of the day. I'm tired, probably just like you guys. Doing my best to explain it to you. I already know I've explained it better in the past. So I'm super happy to hear that I got through to you guys and you understand. I'm really glad about that. To get max profit, do you need to exercise the contract and then sell the shares, or just sell the contract? I find that it's best to sell your option the moment you feel you've reached that optimum point you wish to sell it at. I mean, that's basically it. And if you think that it's going to go up much higher on Monday, then you could convert to the shares, hold over the weekend, maybe check it out in pre-market, sell it in pre-market. That's another cool thing, is that all of a sudden you're holding shares. That's so awesome. You'll be able to potentially sell a little bit in pre-market and get out during the market. But what I will say is that I will find that you're not always going to be right about that. And that Monday, the price is going to be down. And that you will have wished that you got out on Friday for the price that it seemed to peak at. So personally, I try to basically almost always close out my trades at the end of the day, whatever they are. If it's a swing trade and that day in its profit zone, I'm going to close it out at the end of the day. It could be Thursday, it could be Tuesday. It doesn't have to be a Friday expiration day. But that's one more point I do want to let you know about, is that on Friday expiration day, during the last 2 hours, nobody's interested in buying anymore. Can you imagine? Why the hell would you want to buy an option when you only have 2 hours left on it? Okay, maybe you're a day trader and you want to whatever, but a day trader might not be interested in your deep in the money option contracts, that distribution curve like I was talking about. So you could get stuck holding a hot potato. In other words, you're trying to sell in the last 2 or 3 hours of the market on Friday. You may be trying to sell it and nobody's buying it from you. And why would they? To make, $25 in the last hour, and it's just not worth the $7,000 they'd have to buy it from you for. So it is a good idea not to wait till the last minute to sell your options, and you will get stuck holding a hot potato if you wait for the last 20 minutes. You'll find very difficult to sell your contract, to sell your options back. And let's say you had like 40 of them, 40 option contracts, you may only be able to sell 7. There just might not be enough buyers out there. And why would they buy it? Just weird, right? Unless they want that exercised, price on Monday and they want the shares. I mean, yeah, that happens. The contract is worth whatever it would be if you exercised it. Yeah, I'm not sure what you're talking about, Lewis, but yeah, I think so. It's not just a law that it has to sell for the same profit you get by exercising, but that's literally what the fucking contract is. Isn't that interesting? It's a contract. It's literally a contract that says whatever the price of the stock is, you can have this stock at $3.40 by expiration if it's in the money. It is a contract. So like it's not a law. It's the deal. It's the deal you bought, right? So that's why they call them contracts. They're literally contracts that have rules in them that the seller and the buyer agree to. And that's why when you sign all those agreements with your brokerage, that's what you guys are agreeing to. You're preemptively agreeing to all that. And that's why it takes time for cash to settle, because they're settling those contracts, those deals, those agreements you made with other people on the other side of the equation. Those agreements have to be settled between firms. Can you post a link to the YouTube and the VIP? Kelly, I'll try to remember. I'm tired, but I'll give it a try. GY says 0.75 delta. Got it, sir. Best explanation. Well, I'm really glad I got through to all of you tonight on that, because you're now going to lose less and make more. I mean, how about that? Lose less and make more. That's what we all want. Why is the 400 call so incredibly popular with bad delta and out of the money? Because it's 400. It's that dumb. It is literally that. It's a psychological number. And when you're day trading with me, you'll notice, Lewis, when you're day trading, those psychological numbers are everywhere. The high of the day continues to be like 39, or like we're doing a momentum breakout stock, and it's running at a 29. It breaks out 29.07, 0.11, 0.45, 0.47, 0.49, and then it touches, whatever I just said, 21.49, 21.50, and then it starts to pop, come back down. Why? Because everyone had put their stop limit orders and their stop market orders at 21.50, because it's just easier to type. When things are moving that fast, they're just, in general, distribution statistics wise, the most popular choice is going to be the thing that's easiest and fastest and most mentally on people's minds. That's just, psychology. It's very interesting, right? Oh, you just got a notification for your BizD dividends? Fuck yeah. Let me look mine up. I bought a lot. Let's take a look. I have to know. Let's go take a look if mine came through yet. That is going to be cool. Dividend received. BizD, $741. Oh, there you go. Now that's a massive dividend. Woo-wee. What a dividend. We made bank on that. What was yours? You must have got something good too, Kelly, eh? Free money, free money. Oh, that's the other one. Who was asking? Gabby. Somebody was asking, isn't there anything else? Well, BizD, for example, that's another one that's going to be doing well during economic inflation, but it also offers a damn near 10% dividend. So BizD is on a bit of a run because it's basically tracking rates. When they give the dividend, the price drops the amount of the dividend they give you. But if it's a stock that's trending, so this is the trick. If it's a stock that's trending, it usually overcomes that amount shortly thereafter. And for us, it was actually only took 1 day. In other words, they gave me $740. That dropped the price of the stock. The stock then rallied. The next day it continued and it went back to exactly where it was. So in other words, the stock dropped in price, but the next day it's back where it was. And we got the dividend. And guess what? It's actually higher than where we got it and continuing on. So we have capital appreciation and we have income through dividends. You have BizD, and how do you know if you got the dividend? Go into your account, check your account history, transactions, and you'll probably see it in there. You have to get in before the ex-dividend date. So we got in, I think, on the 12th or the 15th, something around then. I alerted it. You got $350, Ryan? Come on. Really? Wow, Nikki says she got it. Or he, I forget if you're a guy or a girl. Probably a girl. What else do you guys say? Webull, you can only choose 2 options, almost 1 or 2. Yeah, that's normal for a cash account. If you want to choose any different ones than that, you probably have to choose margin account. Oh, thank you, man. Also, Fast Jake DeLuca says, I know this is a simplified version and it doesn't include all the moving parts like intrinsic and extrinsic value. But that was a fantastic explanation. Thank you, guys. Man, I'm so glad. I'm so glad that I got through, even as tired as I am. Good. I'm going to be doing delta hedging from now on. Matthew, absolutely. I absolutely recommend that. And by the way, when you do that, you want to turn on beta weighting to SPY. So if your program allows you to turn on beta weighting to SPY, that will allow you to get better hedging. That's it. Just like the most vague answer I know, but if you can do it, do it. Trust me, will be in like perfect nirvana land. Nice, nice, Kelly. Awesome, good. I mean, technically, after 10 dividends, we got all of our capital back. Technically, it will take 2.5 years, but and we're not going to be in it that long. We probably will get out maybe during the next after the next dividend, or maybe one or two more quarters. Long class. Yeah, you're welcome, Faraz. Can I show you how to do that real fast? Possibly. Let me see. Okay. So, like over here, you have to click this. You see this? And now all the beta numbers change, right? Do you see that? Beta weighting. That's over in Thinkorswim. And then you see the delta where it says Oracle 500 delta. When I beta weight it to SPY, that changes to 70. All right, cool. So now you know it's not 500. See, Oracle says 500 delta. That's because I have 5 contracts. That makes sense, right? So I have 500 deltas. However, Oracle moves very slowly compared to SPY. Relatively, it moves very slowly. And that's what beta weighting does, is it remeasures things according to how things move in reality. Okay. And so it changes it to 70. And then I know, I need a 70 on the other side. Right now, I'm not neutral hedged because I bought some SPY puts. But yeah, there you go. Boom. What other questions? Right, there you go. Cool. Which day the dividend was given so I can check my statement accordingly? Tonight. It was given today, this evening, tonight. Like we just got it. It's the latest thing in my transaction history. It's pretty awesome. I was expecting like $700, but it was 741. Damn. That was really good. Just now. Awesome. Yeah, BISD always does that dividend. BISD is a ETF which comprises the top 29 business development companies, BDCs. BDCs do absolutely outstanding during economic reflations after crashes. That's what they were designed for and put into law by Nixon since the Great Depression. Nixon then put them into law. And business development companies are here to rescue small businesses and loan them money at variable rates. They got at crash lows. Like, in other words, the rates were 0.5% recently. So these business development companies, they scoop up 50-year loans at 0.5%. And then for the next 50 years, they loan those out to small businesses who are distressed. And they provide two things. Number one, they provide reconstruction services. Like, in other words, they help them rebuild their small business. So they consult. It's like a consulting type of thing. And they turn around those companies and they turn them into incredible mean fighting business machines. So it's pretty incredible. And they get a piece of that return, as well as they loan their loans that they got for 0.5% out to them at 3, 4, 5, 6, 7, 8% variable rate. So as rates go up, those rates go up. So they're making a fortune on that side. And here's the best part: by law, they have to pay out 90% of their profits in the dividend to shareholders. So bingo, that's where they become an incredible reflationary play right now. And that's why we're in them. So we've been in them for, I don't know, about a month or something, about a month now. And probably got in about a month late. It would have been nice to get in a little bit earlier, but we're doing great. We're doing great on them. I don't think anybody's complaining. $740 dividend. All right, cool. Well, you might want to look into any of these business development companies to help you out. All right, everybody. Thank you very much for class tonight. I'm going to see you in the morning for live trading. Any last questions about all these options? If I don't see them coming streaming through right now, then we're good. All right. Awesome. Yep, you're welcome. Good night. Hopefully that ups your options game. That's really what was the focus and my goal of this class tonight. How much stock of BizD did I buy? Let me see. Probably a bit of a private question, but maybe I can give you some kind of answer. Thousands of shares. That's what I'll reveal to you. Nah, it's okay, man. Thousands of shares. Let's put it that way. All right, you guys have a great night, and thank you very much again. BizD, yes, BIZD. It's on the screen right there. BIZD. All right. Hell yeah. But that's a long-term thing, like 3 to 12 to 18 months hold. But it's a great thing to have like 10% of your portfolio in.